And this is basically the model that is going to be used over and over again, you know, for the next third of the semester and into the last part. The next section of the class is really capital budgeting. So we're going to invest in capital budgets, maybe plant, equipment, real estate. We're going to figure out how much it's going to cost, what the cash flows are going to be from that equipment or that asset over X period of time, or maybe sell off the equipment at some salvage value, or maybe sell off the real estate or sell off the firm at some point in the future. And then we're going to discount that back up to the present to get the present value, the internal rate of return, net present value, break even. Later on, we'll use that to value stocks in the applied session of the course. So the discounted cash flow model and the capital budgeting exercises are the same. If you're buying a piece of equipment, buying a piece of real estate, buying a firm, valuing a stock, the methodologies are exactly the same. Okay, that's why it's so important to understand that. Okay, and I call this part of the class, what I'm setting up here is called financial integration. Okay, financial integration. And why do I call it financial integration? Because it integrates all of the courses in your finance concentration into one lecture. Okay, because it's all combined. It's all related to each other. But they don't teach you how it's all related. They teach it to you in sections and in chapters. And you don't really see how it all flows together. Okay? So the first step in financial integration is determination of interest rates. And how do we determine interest rates? Nominal interest rates. And you should know this because it was on the exam and it was in the homework and it was on the take home and it was in the in-class and blah, blah, blah. So how do you determine nominal interest rates?
Real plus expectations of inflation expectations?
Exactly.
Yep.
So it's real rates of return plus inflation expectations is going to determine the nominal interest rate. Okay? And let's say we do that over maturity of securities, of government securities. And we can calculate the yield to maturity. And if we calculate the yield to maturity for each maturity by government securities, what do we get? What do we get? What is it? It's the yield curve. Okay. And do real interest rates move a lot in the short run?
Yes.
They do not. So what drives interest rates up and down and the yield curve up and down? Okay, over here you guys. Over here. Engage with me, okay? If inflation expectations go up, then nominal interest rates go up or down? Up, okay? And if inflation expectations shift up along the curve, will the curve shift up? Will the yield curve shift up if inflation expectations increase across maturities? Yes, they will. Okay, and if inflation expectations go down, will the curve shift down? Yes. And what are these interest rates called also? What are they also called? They're called nominal interest rates, but they're also called what? No, I'm looking for a specific. You probably want to write this down, because again, I hear in class, I ask these questions like 8 weeks later, and they still don't know that this is the risk-free rate. It's also called the risk-free rate. Okay? So movements in inflation expectations moves the curve, the yield curve, up and back. Now, can the yield curve flatten? Yeah, and then when it flattens, what's the Federal Reserve doing? What are they doing? Are they buying or selling bonds? What? Buying or selling?
Selling.
Selling bonds. It's going to cause bond prices to go down and interest rates to go up. Does the curve ever invert?
Yes.
Yeah. And can the Fed oversell those bonds, causing bond prices to be oversold, and interest rates on the short end to rise significantly?
Yeah.
And when the curve inverts, how long do you have until the stock market peaks and we go into a recession? 12 months to the peak and
24 months.
24 months
to
to
the
the
recession.
recession. Okay. So, what are the three theories? Or yield curve theories? How many are there? Three. And what are they? There's habitat,
Market segmentation.
market segmentation, and the most important, is it? No, that's just what it is. Now, what's the theory? The expectations hypothesis, which is the Fisher equation. Okay. So the key to understand here is that yield curves shift up, they shift down, they flatten, they invert. Okay. Will they have an effect on asset prices and the cost of capital?
Yeah.
Yeah, because we know CFO T+1, if I goes up, do values go up or down? If I goes up, do values go up or down?
Down.
Yeah. Okay, everybody should be participating in this. You need to burn this into your brain. CFO T+1, I minus G. If the growth, we think we're going into a recession, and we think the cash flows are going to go down in the future, what happens to values? They go down. Cash flow T+1 times the multiple equals the value. If the multiple goes down, then values will go. Okay? And then we can do the same thing with the DCF, right? When the DCF, if interest rates go up, then what happens to values? If interest rates go up, then values go.
Down.
If interest rates go up, values go. No. When interest rates in the discounted cash flow equation, the numerator, the denominator, right? 1 plus I, if I goes up, what happens to the values?
Goes down.
They go down. Okay. All right, so we know what happens to the values. And we know that all debt plus equity securities are priced off the yield curve. All debt and equity securities are priced off the yield curve. So if the yield curve shifts up, the risk-free rate shifts up, and prices go down. If the yield curve shifts up, interest rates go up, and asset prices go down. Okay? If the yield curve shifts up, risk-free rate goes up. The yield curve shifts up, flattens or inverts, the risk-free rate goes up. Now, what's important about that is that the risk-free rate is the base rate in the calculation for the cost of capital. Okay? Cost of debt and the cost of equity. And so what we're going to do is we're going to buy a company. Okay, we're IBM. We're going to buy a company. So do well-established firms that generate a lot of cash buy other companies to grow? Yeah, they do. They buy other companies. Okay? So we're going to buy a company. All right? We're IBM and we're going to buy a company. Now, first thing we need to figure out is what is our cost of capital? Because if we can figure out the cost of capital, then we can figure out the discount rate that we're gonna use to discount the cash flows to make the investment decision. So we gotta figure out the cost of capital. And we're gonna figure out the cost of debt. And we're gonna figure out the cost of equity. Now, are IBM bonds traded in the market? Do you think IBM has issued a bunch of bonds over the last 50 years it's been in existence to finance its operations? IBM. Not talking about Google or Apple that have all cash. I'm talking about IBM. Do you think IBM has bonds that are currently being traded in the marketplace? IBM that's been around for like 70 years. Yeah, because when you mature as a company and you get stable cash flows, you're gonna lever up the company. And why are you gonna lever up the company? What are you trying to do? No, but what are you trying to do when you use leverage for the company? What happens? What happens to the shareholder equity? The return on equity, does it go up or down? It goes up, exactly. So if you're a well-established firm that's generating durable cash flows, wouldn't you want to lever up the company at one point to increase the return on equity? Yeah, to reward the stockholders that have been invested in the firm. Okay. So yes, IBM has debt. And couldn't you figure out the cost of the debt? Because we're going to issue some new bonds and we're going to issue some new stock to be able to fund this acquisition. So couldn't we go out into the marketplace right now and look at the yield to maturity on existing bonds that's being traded right now in the marketplace by IBM to get an idea of what our cost of capital could be? Yes or no? Yeah.
Yeah.
So we can go into the marketplace and figure it out. Okay. So we can figure out the yield to maturity on the corporate bonds for IBM. All right. When we calculate the cost of the debt, what's the first factor that's added into the equation? What do you start with? I'm trying to build the cost of debt because we're going to issue bonds and we're going to issue stocks. So how do I figure out the cost of the debt? What's the very first variable that I add in the cost of debt equation to figure out the cost of the debt? Nope. What? What kind of interest? We've been talking about it for the last 20 minutes in the conversation. What have we been talking about the last 20 minutes? What have I been talking about? Nominal interest rates. Okay, what are they also called?
Risk-free rate.
Exactly. So you're going to start with the risk-free rate. Okay, and then we're going to start tacking on what? What are we going to start tacking on? Can IBM borrow at the risk-free rate? The United States government risk-free rate? No. So what are you going to have to tack on?
Expectation.
What?
Expectation.
We could put on probably a risk premium. We could probably add an inflation risk premium, although inflation expectations, as we know, are already embedded in the risk-free rate. But maybe the bond is highly sensitive to movements in interest rates, so you need to tack on an inflation risk premium. Okay? Is there another risk premium that we should tack on? We're going to issue a 7-year bond. Okay? Does there need to be a risk premium associated with the maturity of the bond? Yes. So I'm going to probably add on another risk premium, and it's going to be a maturity risk premium. Okay? Are IBM bonds as liquid as U.S. Treasury securities? Are they as liquid? What's the U.S. Treasury security market right now for government debt? 19 trillion. Does IBM have 19 trillion in bonds outstanding, highly liquid? No. So would I have to add probably some illiquidity risk premium? Okay. Well, let's go back. Can IBM default on its bonds? if they go into a severe recession. Yes. Can the government default on its bonds? Yes, but theoretically no, because they have the printing press. We can always print money to pay the coupon interest and return the principal to the bondholder. So theoretically no. So does IBM have a credit default risk premium? Default risk premium? And do you think there are other risk premiums embedded in the cost of debt
Yeah.
for IBM? Yeah, probably. Probably some others. Probably some others that are, you know, on the margin could affect it. Which one of these do you think is the biggest? When trying to figure out the percentage cost of the debt, which one of these variables do you think is the most, is the biggest contributor to their overall cost of debt? Well, could be inflation. Okay. What else? What do you think is the #1 risk premium? Default risk premium. Exactly. So we know that the default risk premium is the biggest one. Okay. And if we're using the 7-year treasury yield, does anybody know what the 7-year treasury yield is? I know that the 10 years around 1.7, so the 7 is probably going to be 1.5. Let's just guess, just use a number. We don't need to be accurate. 1.5%. All right. So do you think that the credit default risk premium is going to be less than 1.5? That's the risk-free rate, right? Yeah. So do you think it's going to be less than that? No. Could be equal to, could be less, could be a little bit bigger. So you want to use 1.5? 1.5? This is the risk premium, right? And then we're doing a 7-year, right? So how many basis points do we want to add to the cost of the debt for the maturity risk premium? Because it is a 7-year bond, it's not a 3-month bond. Or a 30-day commercial paper. So how many basis points would you like to add to that? Does everybody know what a basis point is? If it's 1%, how many basis points? Okay, here we go. 100. You get that? If there's 0.5%, how many basis points? 50. Excellent. Okay, excellent. So you have to put in basis points. So how many basis points do we want to add to this?
150.
That's too much.
50.
What?
50.
Let's do 50. Okay, and then what about illiquidity? Just guess. I mean, it doesn't really matter. Just as long as you're not too high or too low, you're going to be, it's a bounded rationality, okay? They don't vary, and the range isn't very wide for most established companies like an IBM. So what do you think the illiquidity risk premium would be? 0.7? Let's do 0.75. All right, so there's 1, 2, 3, so that's 4%. 4%. And you know what, I bet if you went right now and looked at IBM's yield maturity on their bonds, they have 7 years left, or they just issued some 7-year bonds, it's probably around 4%. Okay. So you can get to the numbers pretty quickly and you're going to be close enough. Okay. That's kind of the point I'm getting here, is you can get into the science of a lot of this stuff, but a lot of times you don't have time to put this stuff together. Okay, now let's calculate the cost of the equity. What equation do we use to calculate the cost of the equity? What equation do we use? And again, this is all review, right? I'm still doing review. That's why it's called financial integration, is we're basically starting with the old stuff, moving through, and then expanding the analysis to encompass other things and other new things. But we need to know this fundamental stuff. So how do I calculate my cost of equity? Okay, if I'm a firm, I'm going to need to know my cost of equity. All right? If I'm an investor, I'm going to need to know my expected return on the equity. It's the exact same thing. So what equation do we use?
Risk-free rate.
Okay, can you give me the equation? I mean, what's it called? What's the model called? Okay, give me the equation. And maybe we can get everybody to burn this into their brains and tattoo it on their handcuffs. Go ahead.
I don't have the big one.
Okay. How do you calculate the cost of the equity? We probably went over it like 3-4 times in class. So what's the first one? What's the base rate? You were right. What's the base rate? The risk-free rate plus what?
Beta,
You got it. Beta,
market rate of return,
return on the market,
minus risk-free rate.
minus the risk-free rate. And what's the equation called? What's the equation called? You have to memorize this, because they will ask you in the interview. First thing they're gonna come out, do you know standard deviation, and do you know,
Factor time series.
CAPM? And what's CAPM?
Capital asset pricing model.
Exactly, nice job. Use the capital asset pricing model to determine the expected return on the equity and the cost of the equity. There's other ways of doing it, but this is the standard that is used by the investment bankers. Because they're the ones who are gonna be underwriting the security to bring it public, to take the seasoned bond issues and the seasoned stock issues to be able to raise the capital for us to be able to buy the company. Okay? All right, so what's the risk-free rate?
1.5.
What is it?
1.5.
Okay. 1.5 plus, right, 1.5. Okay, so we got two of the four variables right off the bat. All right. Is IBM a big company? What would you think the beta is for IBM? Where does it trade? Does it trade on the NASDAQ or the New York Stock Exchange? I believe it's on the New York Stock Exchange. Yeah, but this company's been around a long time.
Okay.
They've been around before the 70s. Okay? It migrated to the New York Stock Exchange. So what do you think the beta is for IBM? Well-established firm, very large, a lot of liquidity, everybody owns their stock, big company. What do you think the beta is? What's the range of betas? What can the beta range from? I mean, can it be negative 50? No.
No.
Okay. Are betas 0?
Yeah.
No. Can betas be 50? Not really. A large company that's been around 70 years that's kicking off a lot of cash flow. Do you think the total return on IBM stock is highly correlated to the overall return on the S&P 500? Do you think that IBM's total return moves with the S&P 500? Do you think it moves with it? Yeah, it does. It probably moves really closely to it because the larger the firms, the company's betas approximate 1. Okay, approximate 1. So what do you think the beta is for IBM?
1.
1. I mean, Google maybe, and Yahoo, and those other Salesforce and the fast-growing tech companies, they have a beta of 2 because they don't pay dividends and they're highly volatile. And they're in a highly competitive market, but IBM's been around a long time and pays constant dividends and has done it for a long time, and they've grown their dividends for a long time. So what's the average return on the market been for the S&P 500 for the last 10, 15, 20 years? What's been the average rate of return? Again, I've mentioned this like 3-4 times in class. So, what do you think the average return on the S&P 500 has been for the last, 10, 15, 20 years? 50%? 0? 25? No way. 5%? Maybe. 10? So now we have between 5 and 10. What's the average between 5 and 10? 8. Right. So let's just use 8. And you're going to be pretty close. So 8 minus 1.5 is what? 6.5.
6.5.
credit risk premium is 6.5%. And 6.5% times 1 is what? 6.5 plus 1.5, it's going to give you what?
8.
8. So your expected cost of equity is 8%. Is the 8% higher than the cost of debt? Is the 8% higher than the cost of debt? Yeah. Does that make sense that the equity cost would be higher than the debt? Yeah, because who gets first claim on the earnings? Bondholders or shareholders? No, bondholders. Bondholders. So the bondholders get the claims to the earnings first. Do you think that the cost of the capital and the return on the bonds are going to be higher than equity if they get the first claim? No. So they're basically asset-backed bonds, they're collateralized bonds. So the yields are going to be lower. Okay, so you got to check it first. And then what about if the company goes bankrupt? Who gets the proceeds from the assets? If they sell off the assets, who gets the proceeds? Bondholders or the stockholders first? Bondholders. Okay. And the company, can the company deduct the interest that it pays on the bonds? And can it deduct the dividends they pay to the shareholders? Can they deduct the interest on the bonds? Yes. Can they deduct the dividends?
Yes.
No. Nope, they can't. So your dividends are subjected to double taxation. Okay. So you have all of these things that debt has over equity, and your debt costs are always lower than your equity costs. Okay.
And then preferred stockholders get precedence over
Yeah,
regular stockholders.
Yeah,
right?
they're included in here, but companies don't use a lot of preferred, so I'm not even gonna get into it. Okay, it's a very small portion of their capital stack, or what is also called their capital structure. Okay, you haven't read ahead in the chapters, but this is the capital structure, and that's what we're gonna do right now. Okay, so the first thing you gotta do is figure out where interest rates are gonna go, and where the risk-free rate's gonna go, to determine that, because you're looking out and you're forecasting where rates are gonna be in a year from now. Then you're going to use the capital asset pricing model to determine the cost of the equity. And you're going to use the risk premia. Risk premia. Risk premia or premium approach to figuring out the cost of the debt. Okay. Now I got the two components. Now I got to go over to the balance sheet. Okay, and figure out the capital structure. Because we're going to calculate the weighted average cost of capital, which is going to be used as the discount rate that we're going to use to discount the forecasted cash flows from the company that we're going to buy. We're going to see if we should buy it, and then make a decision to buy it or not. Okay, and then I'll walk you through that. So now what we got to do is figure out the capital structure of the company. So yeah, we're going to look at the assets. We don't use the assets to come up with the capital structure of the firm. We use the liabilities. What is the capital structure of the firm, and how are the assets financed by the liabilities? Do you try to match the maturities between asset lives and the maturity of the liabilities? Do you try to match those?
Yeah.
Yeah, you do. Okay. So let's say, and do assets and liabilities have to match? Do they have to be equal to each other?
Yeah.
Do assets and liabilities have to match? Yes, they do, the matching principle. Okay, great. All right, and we're going to have short-term, medium-term, and long-term assets. And we're going to have short-term, medium-term, and long-term liabilities. And let's say that the total value, okay, of this company, now when you see the balance sheet, is that market value of the assets and the liabilities, or historical cost, book value of the assets and the liabilities?
Book value.
It's the book value, so it's a historical cost. Okay. All right, and let's say that the company that we're looking at buying is a $10 billion company. Just to keep the math easy. So what do the liabilities have to be? how much does if the liabilities are 10 billion, then the assets are
10 billion.
10 billion. All right. Does anybody remember how most firms finance their assets? What proportion is gonna be debt and what proportion is gonna be equity on a percentage basis? How are most firms financing their assets? Do we know what the percentages are? I mean, do you think IBM is financed 70% equity and 30% debt? Or is it 70% debt, 30% equity? What do you think it's most likely? 70% equity, 30% debt, 70% debt, and 30% equity. Of the two, which one do you think it's most likely?
30% equity.
What?
30% equity.
30% equity. Anybody else? Anybody else?
I think it's more debt.
It's more debt.
60.
It could be 60-40. Yeah, I mean, it could be 60-40, it could be 30, 70-30. 70-30 is pretty high, so let's just use 60-40. Okay? So we got 60% debt, and we got, 40% equity. Okay. So this becomes pretty easy, right? 1 billion. 2 billion, 4 billion, no. 3. Now the problem is what? We got long-term debt, we got medium-term debt, short-term debt. What are we missing? In the liability stack, in the capital stack, the capital structure, what else do we have here? It's not 100% liabilities. What else do we have?
Stockholder.
Yeah, we have equity, stockholders' equity, owner's equity. All right. So we have owner's equity, and we said that owner's equity was how much?
4.
40%.
Yeah.
So what's the, how many?
4.
4 billion. And then what would be the long-term, how much the matching principle is in place? What would be the value of the long-term assets? How many? Do I use equity to finance long-term assets? Yeah. 7 billion. Okay, and then what about medium term?
2.
2. And short term?
1.
Now this capital structure, and we'll assume that this is the target or the optimal capital structure for the firm. What's the goal? When you're trying to target some optimal capital structure, what are you trying to do? What's your goal? What's the goal of the firm? Okay, what's the goal of the firm here in investing in the assets? What are they trying to get? What's the goal? When you invest in an asset, what's your goal?
Maximize profit.
Maximize
Efficiency.
return. Maximize return. Excellent. So we're going to try to maximize the internal rate of return, right? On the assets. So what are we trying to do for the cost of the capital? We're trying to maximize that too? No, we're trying to do what? Minimize it. Excellent. Weighted average cost of capital minimized. And if you do that, you're going to maximize the spread. And if you can maximize the spread between the return on the assets and the cost of the capital, boom, you've maximized the value of the firm. Now, it's not in the book, which I think is a mistake, but you would get in your intermediate corporate finance class, is you would multiply this by the value of the assets, and multiply this by the book value of the liabilities, and you would get a dollar amount. A dollar amount of IRR on the margin minus the dollar amount at the back, and and you would get some dollar spread. Well, that dollar spread is called economic value add, or EVA. Okay? When you listen to the analyst conference calls for any publicly traded company of a certain size, the CFO is going to be talking about economic value add. And it's basically the economic contribution on the margin to the firm. Are we creating value? And if it ever reverts and turns negative, you're in way big trouble. You're in big trouble. And these spreads for these companies, on average, have to be 100 to 200 basis points spreads. If you can target that over time, your company will live forever. You will be profitable, and you will maximize shareholder value forever. So now, we got the capital structure, we got the weights, and we now have the cost of the debt and the cost of the equity, so we can calculate the weighted average cost of capital. Or what is called WACC. So you want to memorize WACC, you want to memorize CAPEX. Okay? So we want to calculate the WACC, because the WACC is going to be used as the discount rate that we're going to use to apply to the investments that we are going to be looking at to be able to calculate the discounted cash flows and calculate the present value, net present value, and internal rate of return to make investment decisions. So the first thing is, do we know what the cost of the equity is? Do we know what the cost of the equity is? Yes, what's the cost of the equity? What's the cost of the equity? No, the cost of the equity. 8%. Okay. And what's the weight of the equity in the capital structure? What's the weight of the equity? What is it? 40%. Okay. And then what's the cost of the debt? What's the cost of the debt? 4%. What is it? 4%. Okay. And in the book, does the debt have a tax shield? Do you have to pay taxes on the interest that you pay on the bonds to your bondholders? Can you deduct the interest paid on the bonds? Can you deduct the interest? Yes, you can. Okay, so is that a tax shield?
Mhm.
So you have to add in the tax shield. And what's the highest taxable corporate tax rate? Assuming progressive income tax on the corporate side?
35.
It's like 35%.
Yeah.
All right. And then what's the weight of the debt? What's the weight of the debt that we're going to use? 60%. Okay. So what's my weighted average cost of capital? What's 8% times 0.4? 8% times 0.4. Okay, you might want to pull out your calculators, because when we do the discounted cash flows, there's no way you're going to be able to do it in your head. And neither can I.
0.32.
Okay. What is it?
0.32.
What is it?
So 8% times
8% times 0.4.
0.32. So 32%.
No, it's not 32%.
0.03.
What is it?
0.032.
So it's 3.2%? Is that right? Okay. And what's 1 minus 0.35 times 4 times 0.6? Again, you gotta get your calculators out. And you have to get your calculators out, because when we do the discounted cash flows, I can't have 3 people doing all the calculations. I need verification validation. And how are we doing on time, timekeeper?
20 minutes.
Okay. So what's the what's this? I can't do this in my head.
0.0156.
Okay, can you just give it to me in percentage terms?
1.56.
Okay, so 1.6%, is that correct? Is that what everybody's getting? Is that what you got?
1.56?
Is that what you got? Okay, you gotta bring your calculator to class, every class now. Go ahead. Is that right?
Yeah.
Okay, and then what's the total? What's the total?
4.8.
So can we round it up to 5? Just to make it easy. So it's 4.8 and at 5%. What if we do it without the tax shield? Because that seems really low as a discount rate to apply to projects. I think we're gonna buy another firm. I don't think a 5% is probably reflective of the risk associated with that, so I may just back out the tax shield. If I back out the tax shield, would the discount rate be higher or lower? If I back out the tax shield, would the
Higher.
discount rate be higher or lower?
Higher.
Higher. Okay, it's gonna be higher. Would that be more or less conservative? If I'm using a higher discount rate to calculate the net present values, would that be more or less conservative?
More.
Be more conservative or less conservative? If I'm using a higher discount rate, would I be more conservative or less conservative? More conservative or less conservative? More conservative or less conservative? I would be more conservative. More conservative. Okay. So what's the discount rate backing out the tax shield?
5.6.
So basically 6%?
Yeah.
So what we'll use 6%, but usually do you want to use just one discount rate? When you're running investment analysis on a multi-billion-dollar project, would you use just one discount rate? Or would you use a sensitivity of discount rates? Probably use multiple. And would you use 5, 6, 7, or 6, 7, 8? What would be your sensitivity ranges? Would you use 5, 6, 7, or 6, 7, and 8?
6, 7, 8.
You might use 5, 6, 7, 6, 7, 8. If you use 6, 7, and 8, would that be more conservative?
Yeah.
Yeah. Do you want to be more conservative or less conservative?
More.
You probably want to be more conservative. Okay. So let's just stick with the 6%. Okay, now we got the discount rate. Okay, so let's go do the deal. All right. So we're going to buy this company. And let's just use, just to make it easy, let's just use a 5-year holding period. Okay. Okay. 1, 2, 3, 4, 5. Okay, got it. And what is it? It's a $10 billion company, and it generates $100 million a year. Okay. Last year, the company did $100 million in free cash flow. Okay, we're going to use EBITDA. We could have used earnings or something else, but it's a small company, and there's distortions in the earnings, so we're going to use free cash flow. We'll use EBITDA. And last year they did $10 million in cash, free cash flow. Now we got to figure out the present value here. All right. So is IBM a smart company? And what was their discount rate? What was the discount rate that we were going to use to discount this company?
6%?
What is it? So I can set up the discount factors pretty quickly. And you should have a calculator and you should start calculating them out. Because I'm going to ask you for them. And what's this one? What's 1.06 cubed? What's 1.06?
1.19.
1.19. And what's 1.06 to the fourth power?
1.26.
0.26. And what's 1.06 to the fifth power? 1.34. Okay. So I got a lot of the equation already done, right? How fast do you think we can grow the revenues from last year to this year if IBM takes over the company? Can we grow the revenues? Can we grow the cash flows? By how much? You tell me. What do you think we can grow the cash flows? So IBM is a big company. It's got lots of infrastructure, a lot of really smart people, distribution channels, lots of technology. We could really lever up the cash flows, the growth rates. So what do you think we can grow the cash flows from last year to this year?
20?
What?
20%?
You want to do 20? That's pretty aggressive. But we'll check it out. Okay, so it's 1.2 times, so that's what, 120 million. All right. Well, you're the manager of this takeover. You're in a corporate finance department. You're going to be working with the restructuring team to get us that 20%, so you're going to be right. Okay, what are we going to do in the second year? Usually the second, third, fourth, fifth year, you can't grow it as much.
They taper down a little
Yeah,
bit,
they
right?
taper down. So what do you want to use for going from year one to year two? Next year to the next year.
15,
Are you sure?
10?
Okay, so what's 120 times 1.1? What is it, 122? Something like that? Is that right? 132? Okay. And then what do you think we can grow the cash flows in the next year? How much? We do 20, 10,
5,
how much?
5.
Okay, so what's 132 times 1.05? You guys should be doing this on your calculators.
139.
What is it?
139.
Okay. I need validation verification because one time I taught a class where we went through the whole frickin' model and nobody told me that it was wrong. And I had to go back and redo it again. Can you imagine if you're in a board of directors meetings and your team is feeding you bad numbers? That would be awful. That would be awful. What do you think we can grow it out to the next year? How fast?
3%.
1.03, so what's 139 times 1.03?
143.
143. And what about the next year?
1%.
What?
1%.
1? 1.01? What is that?
144.
Now, can I discount this back to the present value to make the decision? Or do I need to do something else? Do I need to do something else? Are these cash flows going to stop after year 5, or are they going to continue into the future?
We're gonna continue.
Probably going to continue into the future. So what do we need to calculate? It was on the last question on the exam, the in-class exam.
Terminal value.
We need to calculate the terminal value. Okay. And then how do we calculate the terminal value? What do we need to do?
You added to the last.
Yeah, but I need to do something first. What do I do now? This is the most important and most critical component of the whole class, right now. So what do I do to the cash flow? Do I do anything? How do I get the terminal value?
Cash flow plus 1 over the interest rate, isn't it?
Yeah, but I have to do something. Where do I get the cash flow? Do I use this cash flow or do I use another cash flow?
Present value. Previous.
What?
Isn't the cash flow we start off with?
No. You have to write this down. You have to write this down. If you leave the classroom without knowing this, it's horrible, okay? You have to write this down. You need to grow the cash flows out 1 more year. 1 more year. Okay? 1 more year. So what do you want to grow the cash flows out to? By how much? You already have it down to 1. Do you use the same 1 or do you grow it out by 1% 1 more year?
1%.
Okay. And then what is the, in T plus 6, the cash flow in T plus 6 is going to be 144 times 1.01. And what is it? 145 million. All right. Now what do we do? Is that the terminal value? Is that the terminal value?
No.
No? How would you calculate the terminal value? How do you calculate the terminal value? How do you calculate the terminal value? You calculated this in the very last problem on your exam.
Use the Gordon growth,
You can use the Gordon growth
multiple growth.
or What's the other approach we could use?
Perpetuity.
Or the perpetuity, we could use either one. With the perpetuity model, what do we assume about the cash flows? Are they gonna grow at a constant rate into the future, or are they gonna be flat?
Flat.
They're gonna be what?
Flat.
Okay, do you wanna use cash flows that are growing at a constant rate into the future, or do you want to assume they're gonna be flat into the future?
Flat.
You want it to be flat, and if you assume that they're flat, are you being more or less conservative?
Conservative.
More conservative, so you wanna be more conservative? Cause you kinda like
Yes.
push it a little, okay, we'll be conservative. So what do I divide that by? What am I gonna divide that by? What rate?
Interest rate.
No, which one? Which rate am I gonna use? Which rate do I use? Do I use the risk-free rate?
Yes.
Or do I use the weighted average cost of capital?
Yeah.
And what's the WACC?
Weighted average.
Yeah, what's the rate?
6%.
6%? In 6 years from now, is the company gonna be older or younger? It's gonna be older or younger?
Older.
Older, okay. Is it gonna be subjected to more or less competition in 6 years? More, okay. So does it make sense for us to use the same going-in discount rate? Or should we add some risk premiums on top of it to reflect the additional risk that we're taking? Because I can't predict what it's gonna be like in 6 years from now. So to be conservative, shouldn't I wanna tack on some additional basis points to reflect that additional risk?
Yeah.
So how many basis points do you wanna add on to the going-in discount rate to reflect the additional risk in 6 years from now? 100, 200, what do you wanna use? 100? So that would be what? 0.07? All right, and then what's 145 million divided by 0.07? Because we wanna get the terminal value. So what's the terminal value?
2071.
What is it?
2071.
Like that?
2071.
2071, so 2,071,000,000, is that right? Are tech companies going for a couple billion these days? Aren't tech companies going for a couple billion? So we're not out of range here?
Yeah.
Okay, so now what do we do with the terminal value?
Add that up.
Do what?
Add it.
To what?
The present value.
You add it to the last value in the holding period, the last cash flow in the holding period. So what's 144 million plus 2,071 million? So what's the cash flow in the last year of the holding period? So what's 144 million plus 2,071 million?
2215.
2215, is that right?
Yeah.
So what's 2215 divided by 1.34?
Or if you rounded up 53.
Is that right?
Yes.
Okay. And then what is 143 million divided by 1.26? 113 million. And then what is 139 million divided by 1.19?
117.
What is it?
117.
Is everybody getting this?
Yeah.
Okay, just want to make sure I'm not being taken down a rabbit hole. 132 million divided by 1.12,
118.
what is it?
118.
Thank you. And what's 120 million divided by 1.06?
13.
113?
Yep.
All right. And what's the present value? Which is 113 plus 118 plus 117 plus 113 plus 1,652 million.
Oh, is that 1 billion?
1,652. So, but just use put the millions and thousands, just to make it easy. So 1,652 plus 113, 117, 118, 113, what's the present value?
2001.
What is it?
2,000.
2,000,
113.
so basically 2,113,000,000, right?
Yeah.
Right? How many minutes do I have left?
5.
5? Okay, I'm gonna get into the decision stuff and then we'll do the rest of it on Wednesday. Okay, so what's the present value? 2,000,000,113. All right. Oh, did I tell you the sales price is 3 billion? We talked to the company. We said, we'll sell you the company, but for $3 billion. So what's the net present value? What's the net present value? If the acquisition price is $3 billion, and the present value is 2.113, what's the net present value?
887 million.
What is it?
887 million.
Yeah, but is it positive or negative?
Negative.
Negative how much?
887 million.
887.
87.
Do we accept or reject it? Reject. Huh?
It's a big negative, right?
It's pretty big, it's pretty big. But we really want the company, right? So what would we do? What could we do? We really wanted this project, and we could go back to the seller and negotiate, right? What would we negotiate? What would we ask for in the negotiation to make it so that we could get this project? What would we do first?
Decrease the cost.
No, do what?
Decrease the cost. You want to
Decrease the cost?
Yeah.
Yeah, by how much? By how much to get this project to be accepted?
807 million.
You got it, exactly. We would ask for a price reduction. In the amount of the negative net present value, you need to write this down, okay? You need to write it down that you carry this thing out one more year, add some risk premium, the going in discount rate, you calculate the terminal value, you add it to the last year's cash flow, you discount it all back to get the present value, okay? Then you get a negative net present value, but you really want the project, you go back and you do a price reduction. You negotiate a price reduction in the amount of the negative net present value. Got it. Because if that happens, if we can do that, the net present value equals to 0. Do we accept or reject projects when the net present value is equal to 0?
Accept.
You accept it. Okay. Excellent, good job. Bad news. Bad news. They will not take a price reduction. What can we do?
Recalculate.
You recalculate what?
Call option.
What?
Call option.
No, we're not gonna do that yet. What do we recalculate? What do we do?
Referees.
Yeah. Excuse me. You would you'd reevaluate the growth rates in the cash flows. Okay? So you could go back and look at the Gs. What else could you do?
Review your assumption.
What?
Review your assumption.
Yeah, such as, give me some actual variables within the model that we could review. Right? Because we may have underestimated the growth rates and they may actually have been higher. So if G goes up, what happens to net present value? If G goes up, net present value goes. If G goes up, the growth rates in the cash flows go up, net present value goes
Down. Up.
up. Okay? What about the discount rate? Could we have overestimated the discount rate?
Yeah.
Yeah, maybe we should have used 5, okay? So maybe we overestimated the discount rate. What else? What other variables in the calculation do we need to go back and reevaluate? What about the terminal discount rate? We have to go back and look at the going in, and we gotta look at the terminal discount rate. Maybe we used too high of a terminal discount rate that gave us too low of a terminal value, which push down our negative net present values. Any other variables? No? Okay, bad news. We use the right assumptions in our sensitivities. Can't get a price reduction. We reevaluated all the assumptions. They're correct, and we still want the project. What would we do? What would we do next? Somebody said it over there. You would calculate a real call option. A real call option value. How much time?
2 minutes.
2 minutes. You would calculate a real call option value. What does the real call option value need to be to accept this project? How much value in the real call option is needed to accept this project? What do you need? What's the value, what's the dollar value of the real call option need to be to accept this project? What does it need to be? Say it out loud.
887 million.
887 million. So if the real call option value is equal to or greater than the negative 887 million, would you accept or reject the project? You would accept it because the net present value is going to be equal to 0. You accept the project. And the factors that drive real call option values is time, management decision, and price volatility, value volatility. Are tech companies volatile in
Yes.
value?
Yeah.
Yeah. So what I'll do is I'll map out the matrix. We'll go through this again. This was an acquisition of a firm. You can do this with real estate. You can do this with capital budgets. Okay, it's the same basic equation used over and over again.